History and description of banks' seigniorage rights with consequences. Seigniorage refers to the profit that a government, and by extension, its central bank, makes by issuing currency. The term has its roots in medieval times when the seignior, a lord or monarch, would earn revenue by minting coins. In modern times, seigniorage has evolved with the establishment of central banks, and commercial banks also play a role in the creation of money. Historical evolution. Pre-central banking era. In the early stages of banking, private institutions issued their own banknotes. The issuance of currency was often tied to the reserves of precious metals held by the bank. Establishment of central banks. As economies grew and financial systems became more complex, central banks emerged to regulate and stabilize national currencies. These institutions, such as the Federal Reserve in the United States or the European Central Bank, were granted the sole authority to issue and regulate currency. Fractional reserve banking. Commercial banks, operating under a fractional reserve system, were allowed to create money through lending. This practice involves banks keeping only a fraction of their deposits in reserve, enabling them to lend out the rest. The money created through this process contributes to seigniorage. Description of banks' seigniorage rights. Central bank authority. Central banks have the exclusive right to issue and regulate the national currency. They control the money supply and use various monetary policy tools to influence economic conditions, such as interest rates and reserve requirements. Fractional reserve system. Commercial banks, under the oversight of central banks, are allowed to create money through the lending process. When banks make loans, they effectively create new money, expanding the overall money supply. Interest income. Seigniorage generates income for central banks and, indirectly, for commercial banks. The central bank earns interest on the government securities it holds, and commercial banks benefit from the interest charged on loans made possible by the creation of new money. Consequences of seigniorage. Inflationary pressures. Excessive seigniorage can contribute to inflation. If the money supply expands rapidly without a corresponding increase in goods and services, it can lead to rising prices. Economic stimulus. Seigniorage allows central banks to inject money into the economy, particularly during economic downturns. By influencing interest rates and providing liquidity, central banks can stimulate economic activity. Debt reduction. Governments can use seigniorage to reduce their debt burden. However, relying too heavily on this approach may have long-term consequences and erode the value of the currency. Unequal distribution. The benefits of seigniorage are not evenly distributed. Those with access to credit, typically the wealthy and corporations, benefit more from the newly created money than those without such access. In conclusion, seigniorage is a crucial aspect of modern monetary systems, providing governments and central banks with tools to manage economies. However, careful balance is necessary to avoid negative consequences, such as inflation and unequal wealth distribution. Central banks must exercise prudence in their monetary policies to ensure the stability and sustainability of the financial system. How money is created. Money is created through a process known as the money creation or money supply process. The creation of money involves both the central bank, often the government's central monetary authority, and commercial banks. The process can be explained using the concepts of central bank money and commercial bank money. 1. Central bank money. A. Currency issuance. The central bank has the sole authority to issue physical currency, coins and banknotes. This currency is considered central bank money. B. Reserves. Central banks also create electronic or digital forms of money, known as reserves, which are held by commercial banks. Reserves are essentially deposits that commercial banks maintain with the central bank. 2. Commercial bank money. A. Fractional reserve system. Commercial banks operate under a fractional reserve system, which means they are required to keep only a fraction of their deposits as reserves. The remaining portion can be used for lending and creating new money. B. Lending and deposits. When a commercial bank makes a loan, it creates a deposit in the borrower's account. This deposit is essentially new money in the form of electronic currency. The borrower can then use this deposit for transactions and the money supply expands. C. Money multiplier effect. The process of money creation is often explained through the money multiplier effect. When a bank lends money, that money becomes a deposit in another bank, which, in turn, can lend a fraction of it, leading to a cycle of deposit creation and lending. 3. Money creation process. A. Borrower obtains a loan. A borrower approaches a commercial bank for a loan. B. Bank creates a deposit. If approved, the bank creates a new deposit in the borrower's account, effectively creating new money. C. Reserve requirements. the bank must keep a fraction of the deposit as reserves, as per regulatory requirements, and can lend out the remaining amount. D. Lending cycle continues. As the lending cycle continues across various banks, the overall money supply expands. Key points to note. Central bank oversight. The central bank monitors and regulates the money creation process. It sets reserve requirements and uses monetary policy tools to influence the overall money supply. Interest rates. Central banks influence the money supply by adjusting interest rates. Changes in interest rates can affect borrowing and lending activities, impacting the creation of money. Money destruction. Money can also be destroyed when loans are repaid and deposits are withdrawn or used to pay down debts. This process helps control inflationary pressures. In summary, money creation involves a collaborative effort between the central bank and commercial banks, with commercial banks playing a key role in expanding the money supply through lending activities. Central banks use various tools to regulate this process and maintain stability in the financial system.